Okay, so if you're buying at the top and selling at the bottom when you're trading, this simple concept is probably the reason why. Now, this concept is called premium and discount, or other people call it equilibrium. And in the last videos, we spoke about liquidity, fair value gaps, order blocks, and now we're adding one more simple piece to help you understand when you should be buying and when you shouldn't. Now, this concept is probably the easiest one that you will learn. It couldn't really be any easier, but it is also incredibly important. So the core idea of it is the market moves in ranges, and within those ranges, there are areas where price is considered expensive and areas where it's considered cheap. So premium means price is higher in the range, and discount means price is lower in the range. So in simple terms, you want to be looking for buys when you're in the discount and looking for sells when you're in the premium. So this is how simple it literally can be, is if you have a price leg, like here for example, and price, yeah, let's say price is up here. Now price can't just continue going higher forever and ever. It has to at some point return to a level. So what it would usually do is return and then continue up. Now this is where equilibrium comes in, because in between this leg here, the low and the high, you have a 50% level. And that means that this level is the discount level. This marks out where premium sits and where discount sits. So everything on this side is in discount, everything here is in premium. So when big banks and institutions want to be buying, they want to be buying it for a better price. So they'd wait for price to come down here and reach this level before moving up. That is literally how simple it can be. And then obviously the same thing goes for this example. It's just inversed. So price comes up to the 50% level. So up here is the discount, here is the premium. And yeah, it's that simple. Now, obviously, you can't enter this, can't enter trades on this alone. But if you pair it with something like a fair value gap, so let's say in this leg here, there's a nice fair value gap, and this fair value gap overlaps with the equilibrium range, then that's a great setup which you could have. So yeah, let's look now to an example on the charts. Okay, so just recently here, usually you should draw these out from the swing lows to the swing highs. So from there to there. So this is the full leg. As you can see, price trades up, it comes down, hits the 0.5 equilibrium level, and continues trading higher. And like I just said, overlaps here with the fair value gap, and price trades higher. So all it's doing is splitting this leg from this low to this high, splitting it in half, and everything above the midpoint here is premium, everything below it is discount. It is literally that simple. It is one of the easiest concepts, but also one of the most important. So again, from here, from this low to this high, price comes down, hits it, and then trades higher. This is everywhere on the charts. It's an incredibly easy concept, and it's really, really easy to spot. But yeah, it matters so much because traders do the opposite. Yeah, most traders do the opposite. They buy when the price is already high and they sell when price is already low. So, like I said, if you use this for, a concept like here, as we can see, price has come down and it's swept out this low here, this liquidity. So you can draw it out from this low here to this high. That's another range which you can draw it out from. And it takes out the liquidity, moves up, and then comes down into a fair value gap, hits equilibrium with the range, and then now it's in the process of trading higher. And this area right here is where you should be looking for buys. So that is as simple as it gets, and equilibrium is, in general, where the better opportunities usually come from. You don't need to have this in your trades. I don't really look for it, but it can be helpful when you're forming your bias for the day if you're really overextended within a certain leg. Like, for example, here, this whole leg up until here, it's overextended. You should not be looking to buy when it's up here. You should wait for a retracement. And that retracement in this case happens in the form of equilibrium and the fair value gap. So yeah, like I said, it's an incredibly easy concept to learn. And you shouldn't look for trades just based on equilibrium, but bear it in mind always and use it as an extra complement. So in the next video, we'll break down inducement, and that is where the market often does trick traders before the real move.